have you back as we continue on. We're going to take a moment to talk about money in this country because, again, the conversations are around recession and where we're going to be here shortly, and things just don't feel settled, do they? Inflation still too high, unemployment still too high. It just feels unsettled to me. Nick Hopwood is a certified financial planner, founder and president of Peak Wealth. He joins me now on the program. Nick, good to see you here.
Thank you.
Always good to have you. All right, so give me an idea. It looks like the Fed's going to raise rates again by 25 basis points, 0.25%. Probably likely in May. That's the expectation. What is that? What does that mean to you? I mean, they keep raising it and raising it and raising it. Inflation's still well above 5%. If you ask people on the street, they think it's actually higher, but as far as their lives go. But what about the Fed doing it again?
Yeah, we fully expect the Fed to raise by 0.25% at their next meeting, which is in early May. But what's interesting is the market is pricing in a 0.5% rate cut by the end of the year and another 1.5% rate cut next year. So we have the Fed raising rates now, but there are expectations that they'll be cutting later this year and next year.
And so what does that mean? I mean, okay, so what does that mean to me? I mean, I'm not buying a house right now. If I were, I wouldn't like the rates very well. If I was paying on a credit card, I wouldn't like the rates very well because they keep going up. But once they start to come back down, that's good again, right?
Yeah, the credit card rates are never good. But if you are a home buyer, the rates are up probably right around 6.5% right now. But probably next year you'd have an opportunity to refinance to a lower rate. That would be my best guess. But right now, with the Fed raising a 0.25% in the next couple of weeks, that's great for money markets. It puts those money market rates right around 5%. But if the Fed is cutting later this year, then those money market rates will go back down, and next year they'll go back down as well. So it's great for bank cash and your emergency fund, but the money markets are not great for your long-term investments.
So what is the plan then? If the money market's good, just to kind of make sure that, like you say, no lazy money, right? You want your money doing something. But where does it go from there? Okay, the money market comes back down. What do you do then?
Yeah, right now, we're getting calls. Everyone wants this 4.7% money market. They're just, going crazy for it. But it's temporary in nature. So I remind people, this is, for money that you need to keep safe right now, not for later. So for the later money, for the longer term money, we're seeing fixed income in the 5 and 6% range, high quality fixed income. And that rate that you purchase today would be good for 5 and 10 years rather than just this year alone. So we steer people for their cash needs, their bank alternatives into the money market. And for investments, they need to be thinking longer term, traditional fixed income, 5 and 6%.
And how long can that last? 5 or 6%. And what if you get locked into this and the things go haywire again and you're back losing money? I mean, I don't know. I've not gotten into a situation like this. Tell us what you think.
Well, if you invest in fixed income like I've been describing, it's not a linear path of 5 and 6%. There's going to be ups and downs, but we're talking about bonds. We're not talking about the stock market. It's a whole different world. And so here's an interesting scenario. If the Fed cuts like we're talking about and the economy rolls over with some weakness, perhaps recession, guess what happens then to the bonds? Rates go down, prices of bonds go up. We could be looking at a front-loaded return for traditional fixed income. And so the next year or two could be way above average, whereas the end years could be below average. But over that 5 to 10 year period, you still have that 5 or 6 average.
So that helps out. I mean, it levels it out. It takes out some of the peaks and valleys is what you're telling me. And that's obviously the bottom line is you want to come out, as we've talked about on this program, Nick. It's not how much money you earn, it's how much you save and how much you invest and how much you end up with and keep. That's the key to all of this, right?
Yeah, and sometimes people talk about my return on investment, but also, it's the return of your principal, absolutely critical. But then tax optimization, right? How much of the earnings do you get to keep? So one of the hottest topics in financial services is tax optimization, whether it's Roth 401k, where you can do 22,500, your HSA pushing 8,000, plus a Roth IRA, Roth conversions. We have some great tax software that we like to do. We take your 1040, run it through our system, and it tells us what is the cost of switching from a traditional 401 to a Roth 401, or what is the true cost of doing a Roth conversion. And we can do all that without having to rope in your CPA, especially if their office is closed all summer.
Well, let me ask you this. So a health savings account, right? $8,000 you can put in, roughly. Does that earn interest? What does that do for you?
Great question. So I have a love affair with HSA, Health Savings Account. It's the only triple tax-free investment in the IRS code. So when you put money in, you get a tax deduction. But most people just put it in, keep it into a bank, and then pull the money out when they have medical expenses. To fully appreciate the triple tax-free benefit, you need to invest the money. And then when you go to the doctor or have a medical expense, pay out of pocket. Allow the investments to grow over time, so then when you use it in retirement, it's a tax-free withdrawal.
I see. So,
most
triple
people,
tax-free.
Steve, most people are doing it the wrong way, and they're not taking advantage.
That's fascinating. So you invest in your HSA, which is protected. You just don't pull any money out of it. You just let it sit there. So 8,000 now, 8,000 next year, 8,000, so on and so forth. Sounds like a pretty smart way to build wealth to me. Why don't people know how to use them?
It's just so easy and tempting when you have a big medical expense to reach for that HSA debit card or checkbook. You know, it's just too tempting. And I fell victim to this when HSAs started back in the 2000s. It wasn't for a while that the light bulb turned on for me. And now I've got quite a nice little nest egg growing in my HSA. And Steve, it's not just putting it into the HSA bank. It's actually investing the money for growth.
All right, Nick. That's some interesting concepts today that we don't normally get. I greatly appreciate that. Nick Hopwood, certified financial planner, founder, president of Peak Wealth. Tell the folks, Nick, where they can find you if they find some of these things to be interesting.
Well, reach out to us at peakwm.com. We can give you a second opinion on the money market, fixed income, HSA, Roth 401k, Social Security optimization. Whatever you're looking for, we can provide some answers.
Can provide some guidance, as it were. Nick, really appreciate it. Thank you.
Thank you, sir.
There you have it. Health savings account. Never considered such a thing as being something you could just leave alone and let grow. But now you know. There you know. Peak WM. There you have it, Nick Hopwood. We're going to take a break. Coming up in the next hour, Larry Ward will be here. The Constitutional Rights PAC. Carlson Purge prompts hundreds of thousands to pull the plug on Fox News, as you would expect. Right there with Bud Light. All right? I'll be right back.